Vertical analysis. Vertical analysis is also called common size analysis, and it is used to evaluate individual financial statement items. The term vertical analysis arises from the up-down or down-up movement of our eyes as we review common size financial statements. We use common size financial statements to reveal changes in the relative importance of each financial statement item, so typically each account or group of accounts. All individual amounts in common size statements are redefined in terms of common size percents. A common size percent is calculated as the analysis amount or the particular account that you're looking at or a group of accounts. So you take that amount divided by a base amount times 100 to get the percent. Common size statements show each item as a percent of a base amount. So that base amount for the balance sheet will be total assets. The base amount for the common size income statement is revenue. These base amount accounts will be assigned a value of 100%. So total assets will be shown as 100% and revenue will be shown as 100%. And then the items that make up total assets will add up to the 100%, and the items that make up revenue will total up to 100%. So here's an example of a common size balance sheet so you can see how this works. So remember, the base amount for the balance sheet is total assets, and this is just the asset portion of the balance sheet, just to give you an idea of what a balance sheet would look like as a common size balance sheet. So remember, the base amount is total assets, which when converted to a percentage will be 100%. And then each of the other items in the assets category will be shown as a percentage of total assets. So total assets is assigned a value of 100%. And just so that you remember, assets equal liabilities plus equity. So when you're looking at the liabilities and equity portion of the balance sheet, liabilities and equity will also be shown as 100% because assets equal liabilities plus equity. So once we have assigned 100% to total assets, then we compute a common size percent for each asset, liability, and equity item used, using total assets as the base amount. So if you remember learning proportions in math class, that's essentially what you're doing. You're figuring out what each item is as a proportion to the 100%. So this specifically is where you are showing the common size percents that you are calculating. So if we're looking at the current year, so the current year's cash and cash equivalents are 48,844. We want to know what percentage of total assets that is. So these are the two numbers that we're going to use. We're going to take the 48,844, divide that by the base amount, which for a balance sheet is total assets. So divide that by 338,516, and that gives 14.4%. Then if you wanted to keep going down the line, because remember this is vertical analysis, we could look at the short-term marketable securities amount of 51,713. Again, divide that by our base amount, which is 338,516, and that gives us approximately 15.3%. This gives you an idea of a common size income statement. Remember, income statement is revenues essentially minus expenses equals net income. So with the income statement, you use revenues as the base. So in this case, it will be net sales. And that is what is assigned 100% as the base. So we want to figure out, if we're looking at the proportion again, we want to figure out what percent are these items in relation to net sales. So for instance, if you wanted to see the common size amount or ratio percentage of net income to revenues, you would take the net income amount, which is 55,256. You would divide that by the base amount, which is net sales. So when you divide that by 260,174, that gives you 21.2%. And again, you can just go straight down the line vertically and do the same calculations, always dividing by the base amount to get the percentage. So vertical analysis is the percentage analysis of the relationship of each component in a financial statement to a total within the statement. And that's what you just saw. So remember, in a balance sheet, the percentages are calculated as each asset item being stated as a percent of the total assets, and then each liability and equity item being stated as a percentage of total liabilities and equity. Then also, as you just saw in vertical analysis of the income statement, each item is stated as a percent of sales or the applicable revenue account. So if you break it down and look at it the way that I have here, to help you remember this, for the balance sheet, you are comparing whatever component amount to the total assets or total liabilities and equity. Then for the income statement, you are just taking whichever account and dividing it by sales. This is just another example here of a balance sheet. You can see how in this case they are showing 1 year here and 1 year here instead of it being in the columns in the format like it was in the other example. But this is just showing you the percentages that are used to analyze the relationship of each component in the balance sheet to the total grouping. And then vertical analysis for the income statement. Remember, sales or revenue will be your base amount. It will be equal to 100%. And then each item below the sales all the way down to net income, they will be computed to a percentage based on the proportion of that particular item to the sales amount, that base amount. Now we can do a quick example of vertical analysis, and this will be for an income statement. So remember, with an income statement, our base amount will be the revenue or sales, and that is what will be equal to 100%. So based on the information that you see here, prepare a vertical analysis of the income statement for Axiom Corporation. So the very basic formula that we're looking at for this income statement is sales minus cost of goods sold equals gross profit. And obviously that's just going to be a portion of the income statement. But just to keep it simple for this explanation, we just have an excerpt of these amounts. So we know that sales will be 100%. We have to figure out what percentage of sales the two other items are. So sales is $725,000. Cost of goods sold is $391,500, which leaves $333,500 as the gross profit. Again, we know that sales will be 100%. So cost of goods sold and gross profit, the percentages of those two will have to total to 100%. All right, so to figure out those percentages, you take the account, divide it by sales. So first we'll look at cost of goods sold. That amount is $391,500. Divide that by the sales amount of $725,000. When you divide that, that should give you 54%. So cost of goods sold would be 54% of sales. And then for gross profit, that amount is $333,500. Divided by the base amount, which is sales, of $725,000. When you divide that, you will get 46%. And so you can see there, these two equal 100%, which is the base amount for the vertical analysis of the income statement.